Candlestick patterns. There's a lot of them, and some people claim they work, while some claim they don't. However, most have no tangible evidence to back these statements up. My name is David from Critical Trading, and I wanted to find out whether candlestick patterns work, and so I backtested two of them on over 18 years of data, on 852 trades to be precise, and will share my findings with you in this video. In this video, I will backtest two popular candlestick patterns, Bearish and Bullish Engulfing. The results genuinely surprised me, as one of these patterns didn't seem to work in its original form, which is how most people would have traded it, but as soon as I made a slight change to it by simply trading it in the opposite way, its performance improved dramatically. So to find out what change I made to go from this equity to this equity, make sure to stick around till the end. I will make this into a short series with more videos that will cover other candlestick patterns, so consider subscribing to my channel and enabling notifications by clicking the bell icon so that you get notified when I publish new parts of these series. Let's start by going over the Bearish Engulfing Candlestick pattern. As the name suggests, this is a bearish pattern, and so it's widely perceived as a signal to sell. The pattern took place on this particular candle. I will refer to this candle as candle 0. This candlestick pattern actually consists of two candlesticks, and so I will refer to the one prior to the number 0, which I will mark as -1. Now, there are 4 criteria in total. Number 1 is that the preceding candlestick, so the one marked as -1, is a bullish candlestick, meaning that its close is higher than its open. So we can see that the opening price of the candle -1 is here and its closing price is here, meaning the criteria number 1 is satisfied. The criteria number 2 concerns the current candlestick, so the candlestick 0 in this case. It's actually the opposite of rule number 1. We want the current candle to be a bearish candle, so the criteria is that the close of the current candle is lower than its open. We can see that the open of the current candle is at this price, with its close being here. The third rule concerns the relationship between the current candle, so candle 0, and the preceding candle. The rule is that the open of the current candle is higher than close of the preceding candle. In other words, we want to see that the current candle opened above the close of the previous candle, meaning there was a gap created between these two price points, which is what I just indicated in blue color. This suggests there's a strong momentum present in the market. And the final rule, number 4, it's similar to the previous rule, but concerns the closing price of the current candlestick. The criteria is that the closing price of the current candle, number 0, is below the open of the previous candle, -1. So the previous candle's open is here, indicated in purple, and we can see that the current candle's close is slightly below it. It may not be very visible on this screen, but the closing price is definitely lower than the opening price of the preceding candle. The rationale behind this last rule, when combined with the previous rule, is that the market is deemed to have a very strong momentum because the current candlestick's body covers the entire body of the preceding candlestick, suggesting that the reversal is strong and may possibly result in a prolonged retracement or even a change in the trend's direction. Those were all 4 rules of the bearish engulfing candlestick pattern. All of these rules were satisfied at this candle, which is where you would have sold if you traded this pattern. These are the rules I will conduct the initial backtest with. I will test this pattern with a simple exit, where I will close the trade when the current candle's closing price is below the low of the previous candle. So the low of the candle at which the short trade would have been open is here, and we can see that the following candle managed to close below it here, which is where we exit the trade. I will test this pattern on daily data on SPY, which is an exchange-traded fund that tracks the US stock market, S&P 500, short only with the exit as I've just described it, with starting capital of $10,000 using 50% margin. Tested period from beginning of 2003 up to now, so over 18 years of data. Let's have a look. There you have it. This pattern is consistently losing money. Granted, one could argue that I simply applied this pattern on an inappropriate market, as equities are biased towards long side. However, there are a lot of educators or services who keep commenting on indices such as S&P 500, suggesting that the market is about to make a huge pullback because there's a bearish engulfing candlestick pattern visible. But as we can see, if one just follows such advice for long enough time, this is what their equity curve would have looked like. But how about if we take this candlestick pattern and don't use it to go short, but instead go long? So essentially, we use the bearish candlestick pattern to buy instead of sell. Let's have a look at the results. There you have it. The red equity curve belongs to the bearish engulfing pattern traded in its original form, so used as a short setup, whereas the turquoise line is the same pattern with no changes to it whatsoever, but instead of selling as prescribed, shall we say, we buy instead. It covers the same time period and the same exit logic, but obviously the exit logic is inverted. It's a surprisingly significant difference, and I'm genuinely impressed with the results myself. Let's also go over some of the figures on the backtest report. We're looking at a total of 167 trades within the tested period, generating an average annual return of close to 9%, which on its own is already beating the index, which is very, very impressive. On top of this, I included the trading commissions in all tests, as I always do, which is extremely important. On the other hand, I did not account for any slippage in these tests, as I'm simply testing the edge of one candlestick pattern at this stage. This is therefore not to act as a complete trading strategy, but rather validation of one potential element of it, an entry setup, so ensure to understand that. Nevertheless, very impressive figures, win rate of 70% with an average profit equal in size to an average loss, which makes a lot of sense. Maximum drawdown of 26% with a Sharpe ratio of 1.68, which definitely makes this pattern worthwhile for me personally to pursue further. But this was just one candlestick pattern, so let's also look at its bullish version and test that one as well, see if it works and combine them together. Let's go over the bullish engulfing candlestick pattern as well. All rules that I've already gone over in the beginning of this video are the same, but obviously inverted. Again, I will refer to the current candlestick as candle 0 and the preceding candlestick as candle -1. So rule number 1, the previous candlestick is bearish candlestick, meaning that its close is lower than its open. Rule number 2, the current candlestick, number 0, is an up candlestick, meaning that its closing price is higher than its opening price. Number 3, there's a gap in between the current candlestick's open and the previous candlestick's close. The previous candle's close is at this blue level, and the current candlestick's open is slightly below it, despite not very visible. The criteria is satisfied though. Last rule, number 4, the current candlestick closing price is above the previous candlestick's opening price. Again, this blue line is the previous candle's open, and we can clearly see that the current candle's close is way above that level, hence this criteria is satisfied also. So a valid bullish engulfing candlestick pattern got generated at this candlestick, generating a long signal. The exit I will conduct the test with is again the same as I used before, but inverted. The trade will be exited if the current candle's close is higher than previous candle's high. So this is the close and this is the high of the preceding candle, resulting in an exit signal. And this is the equity curve of the bullish engulfing pattern tested on SPY, which is an exchange traded fund that tracks the US stock index S&P 500, tested from beginning of 2003 up to now. Test includes trading commissions as per usual. Overall, the equity curve doesn't look as smooth as the one generated by the bearish version of this pattern. Over here, for instance, is a huge drawdown that was generated during the 2008 financial crisis. So the obvious question is, what if we combine both patterns and trade them simultaneously? Let's have a look. And the final equity curve looks as follows. This is a result of combining both bullish and bearish engulfing candlestick patterns, but both traded as long only. So instead of just taking the bearish pattern and trading it in the same way to everyone else, I literally did the opposite. The equity curve looks very, very promising, and I was positively surprised with the results myself. There's a significant drawdown visible here, which is the beginning of 2020, when the markets were affected by negative fundamentals. But again, this is by no means a complete trading strategy. I'm merely testing an entry setup. This test doesn't include any market regime or volatility filters. Let's have a look at the backtest results. I conducted this test on 3 different exchange traded funds: SPY, IWM and QQQ. I allowed to hold 1 position in each of these ETFs at the same time, meaning a maximum of 3 simultaneously open positions at any given time. I conducted the test with an initial capital of $10,000 using 50% margin, and trading commissions are included as always. Total of 852 trades, which definitely is a representative sample. Average annual return of over 12%, which is already beating the index, with an associated maximum drawdown of 27%, which is definitely worth developing further. As I said before, I did not include any market regime or volatility filters. This is literally just the entry and exit with no other rules. Win rate of over 70% and an exposure of 21%, meaning that the system is invested in the market only about 21% of time. Overall, I was positively surprised with the results. Bear in mind that these are only 2 simple candlestick patterns with a simple exit technique, and so there's a lot of room to improve the performance. On the other hand, as I mentioned before, the slippage is not accounted for, which would definitely worsen the performance. As such, this is not a final fully-fledged trading strategy, but certainly is a solid foundation for it, and I myself will take this pattern and develop it further in my own trading. That's it for this one. As always, thanks for watching. David at Critical Trading, signing out.